Hi, everyone. How you doing? Ren, Brock. I don't believe the videos are up yet, Stuart, from the summit. Hello, Didier. So good turnaround Tuesday to everybody. We have a little weakness in the S&Ps with dollar weakness. So some follow through to dollar weakness from yesterday. I know that there's some disagreement. I know some people think this is the top. In fact, someone I really respect, at least in Euro, and Grega will be with us at the bottom of the hour. We're going to have a half an hour with Grega today, so should be a great session, and then the interview. So I was thinking about a turnaround Tuesday candidate, and oil is fading. And Steve was talking about he'd be comfortable buying one more break. So, you know, I think it's a pretty clear where you get out of this thing on back over 41. We haven't been able to close over 41 for a long time. So we could roll over to 39 and we take out 39. Perhaps we're heading to this speed line, which is going to come in around 36 and a half. So this would be a candidate. Also, I think that I just saw we started to fade in the silver. Precious metals could be the same thing here. We've had a nice little bear market rally in silver and gold, but markets generally don't bottom on things like this. So this may be it. When I look at the silver, it's just gotten back to the support level. Okay, so I'm not going to take a lot of time because Steve and Blake have to leave at the bottom of the hour. So, you know, I'm going to bring Blake in right away so he could get ready for what they have to do at the bottom of the hour. How are you, buddy?
Good. Yeah, I appreciate it. We got a couple of meetings that I got to attend, so I got to.
Yeah. So I know it takes time to put the bias chart together. I thought I'd bring you in, and then, you know, maybe Steve could get some words in before you have to go. And Greg.
Okay, thank you. Thank you very much, Dale, and good morning to you, and good morning to everybody. Before I get started, let me go ahead and mention this. Remember, we are at the end of the month, and our seasonal offer is ending. Don't wait. If you've been waiting for, you know, a good price for ForexAnalytix, this is the time to do it. So remember, you get 12 months for the price of 7, or 6 months for the price of 4, or buy 1 month, get 1 month free. And also remember that if you retweet, let me copy a link to that. If you retweet the seasonal offer and respond back to one of the tweets here for ForexAnalytix, you can do it to, you know, there's a bunch of tweets that our company Twitter handle has gone out, so you can do either one or any of them to enter into the giveaway. We're giving away to 3 winners. We're giving away 3 free months of ForexAnalytix plus a bunch of gear too. You know, t-shirt, mouse pad, coffee mug. And then we're adding 3 months to, if you already have a subscription, we'll add 3 months free for you, or you can win 3 months free. So no purchase is necessary whatsoever. You just have to retweet and then also respond to this tweet and say, I'd like to be in the giveaway. So I just put that in the chat box for you if you guys are looking for it. All right, so just had to go over that really quick. Let's go over to the charts, because today I do expect it to be fairly quiet today. Now, if you're wondering why, I can't remember why. I'm just kidding.
The debates?
It's the debate. No one really got that but me. It's Tuesday. Yeah, it is debate tonight. So the debate is, from what I read, it's at 9 p.m. tonight. I haven't confirmed that because I was running around doing other things.
It's at 7 Eastern, I believe.
See, I thought it was at 9 o'clock Eastern.
Maybe that's just when all the coverage starts, but yeah, I
Yeah,
think it's.
so I got to confirm that. We'll but just know that the debate is tonight between Donald Trump and Joe Biden, and it is going to be probably a market mover. Now, I'm going to make it real simple for you from a analysis perspective. If Joe Biden does better than expected, he doesn't sound like completely lost. The stock market you might feel a little bit of selling pressure, which means the dollar might strengthen a little bit. If he's just bumbling all over the place and you go, wow, that's a really bad performance, stocks will probably rally. Because remember, stocks want Donald Trump to win. They don't like it if Joe Biden continues to pull ahead. Again, that's not political. That's market expectations right now. So, and we have to talk about it because it does influence what we do here in currencies. And expectations are fairly low for Joe Biden. I'll give him that much. I mean, people are not expecting a lot from him. Most people believe he's really not very coherent, and he's kind of a shell of a person. And so if he comes out and he, sounds better than expected, stocks might sell off and, the dollar might rally. So just think about that. All right. So we'll be watching the debate tonight. I will be for sure. I'm supposed to run a bunch of errands this evening, but I'm going to have to avoid those. Anyway, so let's talk about the market and where we're at. So the euro's back pushing 117. Amanda in her chat room, she was looking at this inverted hourly head and shoulder pattern. So I'm not a buyer of this, but I can see why. For me, it's not something I'd play, but there's here's your shoulder, here's your head, here's, I guess, the other shoulder, something like that. But anyway, she's looking for a move up towards 117.40. And, if you think about this, okay, this move here, 117.30 is the 161% extension. And I would say that if we continue to get a move, I think that's going to offer some resistance here. For those of you that if you're looking to, sell 117.30, 117.40, I'm going to do this kind of quickly. So 117.30 is the 161% extension. I still believe the euro is bearish. I'm playing into this more longer term playbook here. Yeah, this I guess is fine. This is what I'm playing more into, looking for a move down to 115 eventually, but everybody else is looking for a move to 115. So, if we get shy of it, like 115.20, I might be more of a buyer down there, but it's still 200 pips lower than where we're at right now. Support today, intraday, not, for tonight, but intraday, I think support's going to be down here around these, hourly spike lows, which will be 116.65. I wouldn't expect much more out of that today if we get down there, just because, like I said, it's ahead of the debates. I do expect more consolidation than anything, rather than, some explosive move one way or the other. The cable, what do you do with this? I mean, this is more driven off Brexit news. So, are we consolidating in a triangle? Maybe. I still want to be bearish because overall, we're still below this, this trend line here. We came out of an ascending wedge. So I still want to attack it with more of a bearish bias, but it did hold that 200-day moving average for days, and then we popped up. So I get a little nervous. I mean, I'm just going to tell you guys, I'm not trading the cable right now. So just, you know, but I would be a little nervous just because of the way it's holding the 200-day moving average. But I think for now, we just have to mark up this high, which, as you can see here, you know, from a Fibonacci perspective, that's a 78% retracement. So let's mark that up as resistance, 129.30. And I'm going to keep it on range right now while we're above the 200-day moving average, but I would actually approach it with more of a bearish bias. 128.25 will be support. Aussie. So the Aussie, we are at the 38% retracement. If it's going to stop, it's probably going to stop right around here. So for those of you that are looking for possible shorts, now just in case we continue higher, 71.75, which would be the underside of the previous channel. 71.75, that would be significant resistance. And I think you have to approach the Aussie with a bearish bias. That's why I think right where we're currently at is probably a decent short. I'm not going to short it right now because I got a meeting to go into. So, I already established a couple other trades this morning. If you're in the chat room, if you're in the ForexAnalytix chat room, you already know where I'm at. Speaking of which, hey guys, if you're in the chat room, you're listening in, you guys are on Jumbotron, you want to say hi. This is where if you want to be in a community and be around other traders that, you know, we're not talking about, we don't allow politics talk in here. We don't talk, you know, every once in a while when it's slow, we talk about some random stuff maybe, but for the most part, you know, we are, you know, all about the markets, and you can see we've been chatting for hours, and, you know, positions we're looking at, you know, charts that we're looking at, you know, this is, you know, me from earlier this morning, where, you know, a couple hours ago, Amanda's chatting around, there's, you know, all these different charts, you know, talking about the polls and, you know, or the debates. And, you know, this is, I mean, this is like literally 2 hours ago. Now we're going in about 3 hours ago. So you want to know where we're at all day? We're in those chat rooms. So anyway, the reason why I say that is because if you're in the chat room, you already kind of know positions that I'm establishing in the market for this morning. So let's go back over to, here's the Kiwi, 66 cents. We are up against the, oh shoot, I forgot to do that. Support for the Aussie. Today, I mean, 70.80 is 70.85 is 50 pips lower than we're at. So probably it's going to offer some support today. Kiwi, oh, this is easy. We're at, I'm not going to even change the numbers from yesterday. Why? Because it's a double top. We're back at the neckline. Actually, we can write down support as being 65 cents, which is, you know, the lows here, or 65.30. If we get down there today. Dollar Canadian. You know, the dollar Canadian, I got to tell you guys, it's holding up really well. I mean, we have this big inverted head and shoulder pattern. We're above the, this is 33, you know, 133, well above 133. You know, dips to 133.30 are holding. Now dips to 133.50 are holding. 134.20 is resistance. And I mean, if you're on the short side of the dollar Canadian, you're probably like, you know, crap, it's not going down. You know what I mean? So the target for the inverted head and shoulder pattern is at 135.25. The 38% retracement is 136.30. The 200-day moving average is at 135.30. That's the inverted head and shoulder pattern target. So that is my first target. After that is 136 and some change. Dollar Mexican peso. Here's another one that's holding up really well. Why is it holding up well? That was a weird sound. Huh. It's holding up well because we broke out of this down channel that's held us since the spike high. We broke above the 250-day moving averages and the 55 EMA, and then now we're just holding. So above 22, and then resistance is 21.65. You guys should all know that. 22, support, bullish. Hold on. 21.65 is the 161% extension, although we've been as high as 22.70. I'll just write down 22.65 should offer resistance. Dollar Swiss, very easy. 92 cents is support, because remember, that's the breakout point, right? 93 cents is the 161% extension. So we held resistance. This should be support. I'm leaving it range bound unless we break above 93. You guys know why, if you listen here every day, because if we break above this 93, that means we're snapping that multi-year trend line break, okay? So we'd have to get above 93 cents and we could turn bullish near term. But for right now, it's just range bound. But I think 92 will offer good support today. US dollar, Norwegian krona. Support will be right here at 9.35. It is bullish. Resistance today. Now, I don't think we're going to make it back up to 960 today, but intraday we could make it back to 953. If we decide to rally. Dollar index. Okay. So we're back at 94 right now. The low is 93.98. This should offer support now. Remember, 94 was the breakout point. So for those of you that are expecting more dollar weakness right now, take a look where the dollar index is at. Right? We rallied past 94. It was resistance, big resistance. We got through 94. We hit 94.70, which is big resistance because that is the spike low. We dropped back to 94, which is the breakout point. And now we're finding support. So if you're wondering why the dollar just stopped this morning, well, there's your answer. Oops. Okay, dollar yen, same as yesterday. I don't think we need to change anything here. Resistance, see this trend line here? That trend line will intersect with the 618 retracement basically, which is going to be resistance, which comes in at 105.81, 105.80. So same as yesterday. Support 105.15, which is down here, right? I do want to move that. Keep moving the wrong thing. There we go, right here. That's where, support should be. See, that was the breakout point on that inverted head and shoulder pattern. So that should be support on the way back. It's 105.10, 105.15, but you can see where it's at. Okay. Let's see, where am I at? Gold. Gold had a little bit of a squeeze yesterday, and but previous support which this was 1905. I know it's that spike low is 1902, but I really think 1905 is resistance. And remember, while we are below 1920, you have to approach it with a bearish bias. 1920, for those of you that forget, that was the previous all-time high. So while we're below that all-time high, it's really, really difficult for me to be bullish. And I know we're bouncing a little bit right now, but I'm still expecting a move lower. Just, we're just kind of consolidating these losses, these recent losses. So support intraday. I mean, I want to write down 1850, but the S&P. So yesterday, we were, hitting up against the 38% retracement. We overshot it. The 50% retracement comes in at 3,400. We could theoretically still get up there and still be putting in lower highs. So, you can't write off the stock market ever. So 3,400 would be the next level resistance. Support today, I mean, probably these spike lows down here, right here, be 3,300. And I'm going to keep it as a range for right now because it's the stock market. And, I think we'll get better ideas of what to do with the stock market going into tomorrow. But there you go. All right. So your bias chart is done. Grego Horvat's going to be here in about 5 to 8 minutes. I want to welcome Steve and Stelios and see if they have anything that they'd love to say to you guys this morning. Good morning, gents.
Good morning, everybody.
Good morning, Stelios. How are you?
I'm very well. I'm waiting to see the debate, and it's unfortunate that really it all hinges on how should I put it?
Everything's reality TV.
Yeah, and also how badly or not Biden's going to come out in terms of how well he's going to speak and all that. So it's unfortunate. You see these two. How old are they? 75, 80?
They're both in their 70s.
Yeah, I mean,
and you could argue that both of them kind of are, have lost their minds to a certain extent. It's like
look at countries like New Zealand. Ardern. I mean, she's young. She's energetic. Has ideas. Is it two 70-year-old, 70-plus men the best that we can get from this country? I doubt it, but anyway, they're the two we have. So
I know
it's a difficult question. Anyway, we're waiting for that. I mean, the story of the rest of the year has to be U.S. elections and Brexit. Obviously, COVID.
I would have ran, Stel, but I like doing these summits.
Yeah. Anyway,
Blake, come on, you were going to be my campaign manager.
Yeah. So
he says nothing. Yeah, okay. You don't want an emotional president.
You would make it better. You would make it better president.
The markets are going to be moved by the debates tonight, and
yeah,
I know it's going to be. The market is going to be influenced. So. What are your thoughts ahead of the debates there, Stelios?
It's a big question mark, unfortunately. I really, really don't know. It's the answer. I really don't know. And, people might say, oh, it doesn't matter. It's not an important event. Just like, economic data isn't important anymore. Everything goes up. Forget about it. That's what the market's been conditioned to know right now. And that's so dangerous. So to answer your question, I don't know is the answer. But I think... things should start moving going to the elections. Is it going to be today? Maybe, but we're going to get moving at some point.
Yeah, I mean, I think the debates tonight are going to be moving the market. I think that, we do have a jam-packed rest of the week. Remember, this is a non-farm payroll week, right? So we do have NFP. we do have, with NFP comes ADP numbers. We got GDP numbers. We have PCE, some inflation data, all the ISMs. And then on top of that, we've got the debates, and we have end of month, end of quarter flows that are coming through the markets the next 2 days, which the markets are looking at, dollar buying coming through over the next couple of days. So you got to be prepared for that, because today is the 29th. Tomorrow is the 30th, is the end of day. You might start seeing some of those flows come through today, as we wrap up the European, fixings. So, I think between all of that, we are going to be expecting volatility going into the end of this week.
I agree. I agree.
That's what I'm thinking. And
let's not forget also, sorry to interrupt, let's not forget that there is still talks on the stimulus package. The Democrats have a new proposal which is above 2 trillion. So we are getting there on that front as well. But still, obviously, no firm agreement between the two sides.
Yeah, I guess Pelosi and Mnuchin are meeting today, which is going to be, which might lay the foundation for more stimulus, and that net would be positive for risk, bearish for the dollar. So. But, is something going to get done today? Doubt it. But there are continued discussions. So, overall, that could be something that ends up weighing on the dollar in the next, few days, or maybe even the next week or two. So, yeah.
Hey, guys.
So there's a lot to look forward to.
Hey.
What?
Greg is here.
Hey, Grega.
Hey.
Hey, well, Grega, thank you for being here today. For those of you guys that don't know, let me, you guys are well, just because, I know there's a lot, most everybody here knows who Grega is, but if you don't know specifically how he relates to ForexAnalytix, Grega provides the Elliott wave analysis and all the charts for all the instruments that we cover. I've been following Grega on Twitter for almost a decade now. He's become really a very good friend of ours, and as a company and a great partner. And he's just an overall, awesome guy.
He's also a really good football player and the best looking out of all of us.
So do you play football or do you play soccer?
Yeah, both.
All right. So yeah, and he is definitely the best looking out of all of us, hands down. So
oh, come on.
That's what all the ladies say. Even my wife, she's like, "Oh, he's a good looking guy." Right? Like, "Oh yeah, Grega Horvat." Blah blah blah. Anyway, hey Grega, we're gonna pass the charts over to you. Thanks for coming in today and helping us out. Myself and a couple of us have to go over to a meeting. So thanks for coming in, and I appreciate. I know everybody else is going to appreciate your analysis and being able to see your point of view. So,
is Dale around?
He is.
I am.
Oh,
I'm here now.
Okay. Good.
All right,
Okay,
guys.
are you ready to go, Grega?
Always.
You
Thanks,
are,
Grega.
man.
All right.
Okay,
thanks, Grega.
Blake,
We'll
have
catch you
a
guys.
good one.
Thanks,
have a good
everybody.
one, guys.
Appreciate it.
I'll see you guys. Okay, Grega, you and me, buddy. I'm so
Yeah.
nervous being alone without the team.
Yeah, and without Steve.
I'm shy. Anyway, take it away.
Yeah, I mean, the last time we were alone was when Steve was on vacation, I believe. But even then, he was logged in through mobile. So
We won't
do
tell
not
our
get rid of
wives.
him.
We won't tell our wives about the 2 times we were alone, okay? All right, man. So, yeah, so we're looking at, do you want to start with DAX?
Yes, actually, I have my notes here, and we'll start with DAX. I mean, stocks in general. We have seen quite nice
The bounce. Take your time.
Just a second.
Take a shot.
Okay, so actually we have seen a nice pullback on the S&P 500. It was a pullback of 10%. Okay, and if I firstly go to this chart, let me just try to bring this on. I should have it somewhere here. Just a second. Okay, so this pullback back in June was around 10%, and then we have seen another drop here, which was a little bit more than 10%. But what was significant here is that this drop took us back to these previous swing highs, and at the same time we had this wedge pattern. And I've been tracking this as a potential ending diagonal here for wave C that could complete this drop. Of course, maybe this is also a leading diagonal from the highs, just a bigger first leg drop, meaning that you would expect actually that downtrend would resume. But even this one suggested a bounce, at least in 3 waves. So the way I'm looking at everything right now is that I think that there is more upside coming. We have some nice bullish momentum here that can take us higher here in this first impulsive wave A, and then expecting wave B and wave C rise. Even maybe we will see wave 2 and then wave 3 to the upside. So somehow I'm bullish on stocks and would not be surprised to see actually a retest of all-time highs. I mean, after all, trend is up and there is no reason to fight it, especially not if you do not have any significant 5 waves from the highs. So if we look back on DAX, just to confirm what I'm looking at on the S&P 500, well, DAX really did not go far over the last few months. We are just stuck in the range after this very nice and strong rise here from the March. So for me, there's no reason to look for a top. I mean, even if we go a little bit lower here, I would still be looking for a correction. But I think that the trend is very clear here. And if we consider that the S&P 500 is the strongest, it was at all-time highs. Well, DAX actually still did not pass these highs from earlier this year. So actually there is room on the market which is weaker that will actually make more gains. So this to me makes sense that if this market will continue higher, then I think that the S&P 500 will actually at least come very close to its highs. So what I'm looking at here on my primary scenario is that we are trapped here in a triangle. Now that's an ABCDE pattern. You can see it here on the right. This is wave A. You have a wave B moving to a new high, which is fine because I'm tracking a running triangle. And then you had a 3-wave drop for a wave C. And last week I was looking for this bounce. I didn't know what kind of a bounce will occur, but it was anticipated because of a 5-wave drop from this wave B swing high. So I knew that at least corrective rise will occur. But since this recovery is looking very strong and significant, I think that we are actually headed even higher, probably even above 13,000, but only for a wave D. Then I will be looking for another pullback before this whole correction will be completed. So the way I'm seeing things, consolidation on the way up. Also, on the other hand, we know that if stocks will continue higher, then US dollar will probably not be looking for any significant gains. And if you look at dollar index here, we are consolidating around this important trend line here on the monthly level. So maybe we'll not see any aggressive sell-off just yet, but it looks like that bulls and bears are struggling here on both sides. But what we have to respect is probably the lower time frame structures to identify really what may happen next. And if you take a look firstly on this chart, okay, on this chart, it's a very clear technical analysis, no Elliott waves. I mean, sometimes we just don't need it and to recognize the next potential move. And what I see here is that we are trading below this trend line resistance, right? Then we had this rise that was made by 3 waves, exactly back to these previous March lows. So bears actually, it looks like they want to be back in play from that area. We are already reversing, and what is even more significant is that this same zone came at wave C to wave A level, okay, at this measurement.
Quality,
so
yeah.
we have everything suggested that suggests that dollar could actually weaken further. And if we consider what the stocks are doing, I mean, I would not be surprised.
Can I
Also,
propose an alternate scenario?
some
And
alternate
just
scenario. Well,
yeah.
if we see this, here's my alternate scenario.
Okay.
If we see this broken trend line, okay, and we pass 95 level, then probably this rise would not be corrective, or at least would not be finished.
Right.
Okay?
That's
Maybe we will see then higher complex corrective recovery, whatever, but in such case, I would be looking for more upside. So definitely, I would be then looking probably towards 96 or so, but the question will be, what is the structure of this recovery? Is it impulsive or is it slow? Is it slow and overlapping?
If that happens, Greg, is there a possibility that after that corrective pattern that you had in S&Ps, that we had A down and this corrective pattern is a B up with one more corrective wave to the downside for a C?
Yeah, on the S&P, yes, and exactly. And that in such case, maybe dollar index could rally further towards 96, as I said, yes.
Okay.
So, but the pattern, I mean, trend for me is very clear here. Based on the Elliott wave structures, I cannot fight this. Here we have this ABC structure. Looking at the 4-hour chart, I mean, it's a very clear and quite nice reversal so far from the upper side of this corrective channel. So always when I'm trying to recognize or decide whenever we are looking for a top of a wave C, I definitely want to see a reversal from that same trend line, parallel trend line. And this is exactly what is happening right now. It would be completely opposite if this trend line would be broken. Then this would be indication that we are actually accelerating to the upside rather than reversing back lower. So I
also,
think
would you consider that line in the sand there at 93.65? That would give confirmation for higher probability for a new low.
Yes, exactly. So I'm waiting to see if maybe this will happen in the next 24 hours because of Trump and Biden that will take their seats today. So we will see what the market brings. But so far, looking at the 1-hour chart, it looks like a very nice reversal already happening away from the highs here. So it looks like that this is a small impulse. So I will be looking here for more weakness. But for something more significant, I definitely want to wait a little bit more, and would love to see maybe price overlapping this bearish level before I'm fully convinced that market has topped out here. Also, let's take a look at the euro dollar. Since we mentioned this, euro dollar is also looking to make a swing low here. So looking either for a wave 4 pullback of a new impulsive bullish run away from 106, or maybe this is a sub wave 4 of wave C. But again, important is we are reversing from this lower trendline support from equality level. But again, I think we should wait a little bit more towards 1770. If we can see this level and maybe even daily close above that price, then this would increase the odds that we are probably bottoming here for a wave 4 because of the overlap that would make then later with the wave B. So I think that if someone is turning aggressively bullish on the US dollar, well, it's the market to decide what it wants to do here at these key levels, because simply dollar index respected the resistance. So far, the euro dollar is respecting the support, and I think that it would be too soon to turn aggressively bullish on the US dollar. Also, looking at the Aussie, Aussie is currently bouncing very nicely from this 0.7 psychological support. This was the previous swing high here. Then you had also this swing high here from June, and it looks like that market now also tried to turn up from this 38.2% of this wave 3 that I was looking. It was what, 1,000 pips or so. So it looks like that some bulls are trying to push the price higher here, and looking at the 4-hour chart, this is not a surprise. Why? Because we can count actually 5 waves down here from this wave from September 16 highs. So this current bounce is normal, but still, again, confirmation that we are really headed back maybe into this wave 5 here on the daily level. We need this 71.90 to be overlapped. I would love to see a daily close price. I always keep an eye on daily and weekly closing prices. I mean, that's after all the most important price of the day. Also, it's worth to mention that we are reversing after this head and shoulders pattern reached its target down there. Okay, so it's quite interesting. If we see Aussie maybe going higher, we see the S&P 500 also ready to make more gains there. And if Aussie will catch these moves, then I think that there could be some very nice opportunities still on the long side of Aussie actually. If I go back to the S&P 500 and give you this 4-hour chart, or maybe even better 1-hour chart here, I would be looking for this support at the previous wave 4 swing high. So I think this level is quite interesting if we get this wave 4. Also, let me check where the 38.2% is. It's a little bit lower. So the whole zone here, I think it's quite interesting for potential resumption higher. Also, wave 4 can sometimes be similar compared to the wave 1. So if we also try to add this fib, I'm doing this is because I want to show the significance of different Fibonacci applications that actually suggest or points towards the same zone. Okay, so you have here now the 38.2%, you have wave 4 in that area that equals to wave 1, you have this former wave 4 swing high that could also act as a support. So I think that trend is very clear here, and I will definitely be looking for more upside as long as we are trading above this wave 1 invalidation level. Now, if we go back to Aussie, so if we move higher here into wave 5, on the S&P 500, then I think that we will get this overlap with wave A here on Aussie. So this would be quite nice because risk on would suggest that Aussie is also back in this positive risk on sentiment.
Okay.
Okay. Dale, do you keep an eye on questions?
Okay. I am. And guys, go ahead. Someone, NG, would like you to go over silver.
Yeah, okay, we
That's
can
a
look at metals, sure. So firstly, gold. I was looking for a pullback here on gold. I think it's a wave 4. We will see when it will bottom. So far, it's a little bit soon. Because on the 4-hour chart here, I have my fibs a little bit lower here. I'm looking for wave C equality of wave A measured from end of a wave B. So that's still room maybe even to move into this consolidation here, very small one, looking back from start of July. So this would be quite interesting zone. I mean, even the 1-hour chart here shows only a 3-wave movement, so it would be still too soon to look for a resumption higher. But generally speaking, I think that we are in a wave C. This 200 simple moving average, it's quite important. I think it shows where the trend is, and always when we are retesting it, market turned up in this uptrend. Here's better a better view of that pattern. Actually, we are making the same pullback compared to that one back in March. So everything comes in around this 1830 area where I think quite nice bounce could occur. And if we really get this impulsive reaction from the supports, I think that there would be a lot of reasons why we can be looking back higher again. So
you have any level that would end the bull case in gold where the bears would take control? And this is not a wave 4, but that was all of it?
I mean, that I would turn bearish aggressively. That in such case, let me just look here.
Just good to know, you know, just in case corrections extend. Would the point of control be about?
We can, you know, wave 4 will usually retrace for 38.2%.
Right.
That's just the most common level. Okay. This is actually around 1700.
Okay.
But sometimes you will see even retracement towards 50%. But if I ever see a retracement of 61.8%, then or maybe even above the 50%, then that's will be an important alarm for me that something else is going on.
So 1600 is kind of an area that if we're trading down there, there's something else happening.
Yes,
gold.
I mean, definitely we should be considering different scenarios if we go that deep. Of course, the question will be also what kind of a structure we will have in this drop if this will be the case. If it will be strong and impulsive, I know that I will be looking much lower. If slow and corrective, I will just try to adjust the wave count. And again, we'll be looking back towards the highs. But for now, I think it's just too soon. I mean, the reason why I'm looking for more upside and expecting this to be the whole correction.
Because it accelerated through that uptrend?
Yeah, I mean, the reason, what I'm trying to say is the reason why I'm looking for this to be the whole movement as a correction is because we had this triangle in the middle. And as you know yourself, this cannot be wave 2, right?
Right.
So, because triangle never occurs in a wave 2, meaning that you are seeing the final thrust out of this triangle, final piece of this trend that is currently down away from August highs.
Okay.
Okay,
so do you want to continue or you want more requests from attendees?
Let me just look at silver since you mentioned it.
Oh, yeah.
I mean, yeah, silver is also in a corrective pullback, ABC from the highs. It can be wave 4, maybe even wave B or wave 2 for higher degree, but the trend is clear. I think that we will see a continuation higher and that lower we go, the better support will be for maybe for some longer term investors who are looking to buy this market.
A lot of people looking at 19, Greg, you know, that was the breakout. That's where I don't think it should get down there to 19. It's kind of like, why should you give people a chance to buy it again down there? But you think it could and still be bullish, right?
Yeah, I think that a lot of traders found themselves on the wrong foot after this first drop. Why? Because, you know, even if they bought after this sharp drop here, market went quite nicely to higher, back from 23, 24 back towards almost 29. So what you will do? Well, probably you will go out if you see market retesting again these lows, because you will try to protect your money, right? But if from an Elliott wave perspective, that's actually the important key point where the reversal usually occurs. Why? Because those who will try to trade on the downside, on the breakdown, well, actually they will be looking for shorts at the end of wave C. So they will need the wave 3 sell-off to make this happen, okay?
Yeah.
And looking at the trend back here, I mean, it's very clear that we are in an uptrend.
Yeah.
So I think that any dip is just going to be sooner or later limited here. So because of this reversal and break below 23.38, the market just probably cleared some of those who were long. So if there are less longs, well, it's most likely going to happen that we are going to see a bounce, in my opinion.
Okay.
So looking at the 4-hour chart here, maybe another dip is coming. Here is wave 4, looking for a wave 5 push towards 20, maybe 21 level retest. If we rally above 21.77, it will be an early indication that we are already completing this whole pullback.
Okay. I have a request for USD Cad.
Yes,
And
I mean, dollar CAD is very interesting. It's moving here on a daily chart. It's moving towards some very nice resistance here at the 38.2% of this wave 3. We have also crude oil that is making a pullback as well. And I'm ready on dollar CAD, maybe if we really see a risk on just continuing through the week. If we see commodity currencies also picking up, I mean, we have seen nice bounce today on Aussie, but we do not see this on dollar CAD lower just yet. But if we see crude oil maybe completing that wave C down, if I just go to the crude oil here on a daily chart or a 4-hour chart, even better. Once we will see this wave C drop back below September 08, then I think that it will be very interesting for potential new reversal higher. And again, it will be actually the same story like we have seen on silver. Okay, we have seen a very nice bounce after this first shock. So I'm waiting for a second shock that will confuse a lot of traders, investors, and actually that could be a nice indication that we are really finally headed to the upside when.
yeah, it's weird, the crude, Greg, when we had risk off last week, it didn't break. And now we have risk on and it's not railing.
Yeah, it's quite interesting. I think that maybe there is some sideways going on because no one really knows for sure what will happen if with coronavirus figures. I mean, are we going to see a next lockdown here across the Europe? I don't know. And maybe traders are really undecided in this story. So that's why we are just seeing sideways price action, I believe.
You know, up until recently, copper, someone's asking for copper, has actually held up longer than the precious metals and finally started to come off a little bit. And you know, copper is a pretty good indicator of global economic growth. You have a view on it?
Yeah, I mean, copper is definitely looking bullish there. I have here an Aussie template because they are obviously correlated. I'm looking here at a very nice and clear impulsive recovery. We came down here, so maybe we are stepping in a new corrective phase, but from a longer term perspective, I think that copper could be very good when looking for potential opportunities, but maybe there is better just to wait on markets to come a little bit lower. I'm not sure if obviously these markets do not go tick by tick with stocks and even not with Aussie. I mean, we have seen, for example, on Aussie earlier top and then copper followed. So it's not all tick by tick, but from investment perspective, I think that this one can be quite interesting. I mean, we have also seen commodity index reversing higher, and it looks like that there is a new uptrend, new cycle going on. So I think that
the grains have been very strong.
Yeah, exactly.
Yeah, so okay, you're getting applause from attendees. Excellent analysis in a tricky environment from Jess. Cheers. Someone asking about Aussie Cad.
Aussie Cad. Okay, that's a tricky one.
They're all tricky to me, Greg. To you, maybe not, but to me, I'm always getting tricked.
I'm looking at those crosses. Normally, when we have ATR very low on the FX markets, on the majors, okay, because that's probably when the crosses will move. Okay, so it's really important what is going on the dollar. So dollar, for example, is now it was quite volatile, And that's why I think that majors can be very interesting to trade. But if we see majors moving sideways, trapped in smaller ranges, that's when I normally shift and look at those crosses, because then maybe some news, some events could actually be could be a catalyst for a next potential move on those cross pairs. So looking here at dollar CAD, I mean, it's definitely here Aussie in much better position compared to CAD, and looks like that we are now trying to complete this corrective setback here.
Yeah.
It's actually quite interesting, and I really love the fact that someone bring this on, because if stocks are going to recover, if dollar CAD is coming down, if Aussie is continuing higher, and then you have Aussie CAD going higher, then you know that which pair you should track. You should trade actually in a risk-on environment. It's definitely going to be Aussie
Good tip.
US dollar rather than Canadian
Good tip.
dollar. Yeah.
Can I be selfish and request a pair for me? And I don't know, were you through with Aussie CAD or no?
Excuse me?
Were you through with your analysis on Aussie CAD or not?
No.
No, okay, go ahead. Because I have one request for me.
Just a second. Let me check here. Cable, yes. We almost forgotten cable.
See, that's what I wanted to ask you about Euro Pound, because I noticed, you know, your constructive Euro, your bearish cable,
Yeah, but
and Euro Pound went to one of my targets at 61.8 Monday on the opening and bounced. So, you know, to me, Euro Pound is such an important pair for trade selection for me, what I want to be short or long, depending upon direction of EG. Wondering what you were thinking there.
Yeah, I mean, cable here is breaking this trend line on some optimism around Brexit here, but still think that there will be limited upside. We just cannot ignore this important break that occurred this month below this trend line, and maybe this same trend line. If I just try to zoom this in, let me check.
Would that come in 31-ish?
Yeah, I mean, if we can retest this trend line from the outside, that would probably be too good to be true. I mean, because this trend line comes in at the same resistance level as I have here for wave C of this flat correction. And also, always when I'm looking for a retracement, I would love to see, at least of a higher degree, I would love to see retracement for 38.2%, ideally into this 50% area. So let's try to focus on 1.3 psychological level up to 1.31. That's a very nice potential reversal zone. And if we reverse from it, I mean, I'll not be surprised that we will. I think that there is big downside potential, because we should not forget that this was, it appears, only a free wave recovery.
So this would, to me, just looking at your analysis of cable intermediate term and Euro intermediate term, would lead towards a pretty bullish outcome for Euro Pound.
Well, I've been looking for a wave C or maybe even wave 3 sell-off here on Euro Pound from last week.
And we got it.
Yeah, and we got it. And now, I mean, we are trying to make a base here, to form a base here. But again, maybe we have to see 91.50 to make sure that this trend is still here in the cards toward higher prices.
Okay.
So
we'll wait for confirmation.
Maybe we'll just continue sideways. I mean, keep in mind that even cable here can rally another, maybe even 200, more than 200 pips. At the same time, when euro dollar could also recover 200 pips. So it may not be the case that euro pound will move straight to the upside. It could be just sideways. Because
not straight, but intermediate term, with your views, if cable's heading to where you think it is, and I certainly did not see big downside targets in euro, you would think EG could perform quite well. Just, you know, my amateur opinion.
Yeah, of course, it's everything about Brexit as well. So,
Oh, yeah, that's true.
so it
Okay.
can be very volatile, you know, that sometimes pound will move out of nowhere, and even
Yeah.
and then you have some very important news and events happening, then you know that pound will be very volatile.
Okay, well, you know, great presentation. I want to wrap it with this joke. Don't be penny wise and pound foolish. So, Grega, I love your work, man. You
Thank
know,
you, man.
yeah, I really appreciate you
And I
coming.
love to work.
I could tell. You know, at the summit, I asked Jack Schwager in his book about unknown wizards. Like he wrote in his book, if you're thinking you could work a couple hours a week and do 100% on your money, this book isn't for you. So I asked him about his unknown wizard. I said, they have a very good work ethic, don't they? I mean, don't they even work more than 8-hour days? And he said they all do. They all put a lot of time into it. That's an ingredient, plus the discipline. I mean, you could put in time, and if you don't have discipline, it doesn't matter. But they're all hard workers. Every successful trader I know is not lazy, just waiting for money to drop into their account.
Yeah, and probably you know why? Because they are working this with passion. I mean, from
That's
the
right.
beginning, when you're in the markets, if you don't have passion and if you don't love it, then
Yeah.
you will have very hard time sitting in front of computer, I don't know, 8 hours. I know that at the start I remember the day when I received the book from the US because I was unable to buy it into Europe, the Elliott Wave Principle. And I know that I was in office for more than 15 hours looking at the book, writing down notes and checking the charts live. So I was so excited, you know, and I was not thinking about money at all. I was just thinking about everything around that, not just money. So
Yeah, you know, Grega, at my age, I don't have the same stamina I used to. And every once in a while, my brain explodes with like, you know, overload of information. But I still love it, you know, after all this time. So, and what makes it great is working with guys like you. So thanks again, my training warrior brother.
thanks, man. Have a good
Okay,
day.
so
Thank
if
you,
you could,
everyone.
yeah, so, you know, Grega's work's at your fingertips as a subscriber or at, you know, if you're just interested in Elliott Wave work, you know, Grega has his own service to check out as well, okay? All right, I'm going to bring in our guest, Adem. Greg, if you could maybe stop sharing, and I'm going to promote you, Adem,
Yep.
right now. Thank you, bro.
Thank you.
I'm going to promote you to a panelist. There you are. Welcome back, Adem. Waiting to hear from you. I'm asking you to unmute.
Sorry about that. How you
Oh,
doing?
there you are. How are you, buddy?
Doing good. How have you been?
Rocking
Oh,
and talking to famous people, and you know, got to talk to one of, you know, a guy I admire, Jack Schwager, at our summit over the weekend, and you know,
yeah, I
hoping
love
one
his
day
books.
to be an unknown wizard. I told
Mhm.
him that after his book gets out there, those unknown wizards will not be unknown anymore. So anyway, do you remember how to share a screen here? It's that
Yeah.
green, yeah, that green share screen. How are things in Arizona, bro?
You know, it's the weather's getting better, but
Yeah, yeah, I know. I live there.
Corona had a pretty big spike over the
Yeah,
last few months, so pretty much just trying to,
hang home.
rebound from that.
Yeah. Okay. This is a look at your letter, right, buddy?
Yeah, this is just on my page, but I was
All
just
right.
looking
Well,
at
okay.
some.
I think it's a great. Are you going to talk about the corporate bond market? Because LQD, you know, I'm following it. And before we get going, you know, there's two stories. Like when the Fed came in and the bond markets all locked up, And the Fed, some people think the Fed came in and bought corporates. And some people said big rally we had, that big recovery was all jawboning. Which was it?
Well, I know the Fed started buying corporates in May, but it wasn't, it wasn't
Big.
Enough. Yeah. In my opinion, it's all forward guidance. It's the idea that they say something that the market prices it in, which is probably the Fed's best tool, which we can expect to hear more about. But what the downside from forward guidance is, and I'm sure you've noticed that when they make promises or they say, hey, we're going to, get 2% inflation, or, the bond market's safe, or, et cetera, and then it doesn't live up to expectations, the market reprices that very fast.
Okay. All right. So what do you want to talk about today? You want to stay on this and look at some, tell us what you're advising your subscribers to do in this pretty difficult environment.
So yeah, I was last time we spoke, I was telling you I really liked uranium, and it's gone up about 30% year to date, but I think it has more upside with the supply cutoffs happening. I know demand hasn't really been recovering as much as people expect, and I think that it's not going to continue expanding globally. If you just look at Euro area deflation, they just had deflation for the first time in years. China's exporting a ton of deflation with their cheap producer prices, which is pushing prices, globally downwards. I think you're going to see oil lower because you have the marginal producers, the US, and frackers are starting to turn back on production rapidly. And then Russia and Saudi Arabia since they have nationalized oil, they obviously don't have the luxury of, a market economy. They have to produce oil to generate their government revenue. So I think fracking on the short side of oil, I'm looking back on that, long dated out of the money puts. I'm just trying to see which ones are, cheap relative to the upside. And I think with the economy right now, I think with fiscal stimulus talks, I'm not sure. I think that, what's going to happen with that. I think tonight the debates are going to be really interesting, but I think the market's been pricing in this inflationary recovery. The US dollar has dropped almost 10% year to date on, assumptions.
What do you think? We've had a little recovery in the dollar, a few weeks. Dixie bottomed around 91.80, got into the mid 94s. If you're in the deflation camp, would I be correct to think that you're a dollar bull and that this dollar weakness could completely reverse itself?
Yeah, actually. So I made a case last year for both. My personal belief is the dollar's going to get stronger just because of the global dollar shortage. You see the Brazil real. I was just looking at it rolling over. I'm looking at the chart, the 1 month right now starting to roll over. And then you have the ZAR, the South African rand, rolling over. The Turkish lira obviously rolling over year to date. So you have all these major emerging economies. India's not recovering, and their pandemic starting to get kind of out of control. The China economy isn't really. China's obviously the key. China's the global marginal growth producer. I was reading this BIS report saying that post 2008, China has pretty much carried global GDP 49%. So, when China sneezes, the whole world catches a cold.
It used to be us, and now it's them.
Exactly. It used to be US and the developed markets. But a lot of analysts I see, they talk about US growth or US inflation and, rebounding. But, you and I talked about this last time. You always have to look at the marginal change. And China and India are the only countries of size that are going to grow, 5 to 10% per year for this foreseeable future. You're not going to see America or the EU suddenly grow 5% on average, probably for the next decade. It could, obviously, but, I don't think that's likely. So for the kind of growth to happen, to actually carry worldwide, the world economy at this scale, it's going to, be China or India. So India has really bad infrastructure problems. I'm not, India's been like the holy grail that's supposed to like blossom for the last like 30 years, but they
I've
just
been hearing it my half of my life.
exactly. Yeah, I mean, it has all the fundamentals in place, I guess, with the population, but it's the infrastructure is poor. China is the marginal growth engine. So, but the problem you
So
have with
if
that,
they ever have troubles, the whole globe's in trouble. And
exactly.
there are China bears, but you're constructive on China. Is that what
So
I'm gleaning?
I'm actually bearish on China in a way of they have a lot of problems structurally. Like for instance, they realized in 2016 when President Xi like took hold pretty much of everything. He pretty much came out and he said he wanted to tighten the shadow bank industry. And he said that there was a housing, remember the housing bubble in China? It was like rampant growth. They were just building malls. Yeah. So in the house prices that weren't even built, I'm sorry, houses and condos that weren't even built were being like bought. And I just saw an article on Bloomberg that like a firm that was like selling properties that hasn't even built yet, put down big deposits for these homes being built. They sold out, but then the firm went bankrupt and they didn't like give the depositors their money back. So there's a lot of like, schemes, and they had wealth management products, WMPs, that Jim Grant from Grant's Interest Rate Observer in 2016 was warning against for the extra yield, but they were, kinds of like a Ponzi scenario.
Wow.
So with China, it's a very hot money economy. They depend on inflows, so they have to keep their dollars up. But China has a ton of US dollar debt maturing over the next couple of years. So that also, in my opinion, is going to keep the dollar pretty much afloat, higher, especially when you have all these emerging markets like Argentina recently. I don't know if you saw that they pretty much put on capital controls to prevent dollar outflows. But
Argentina, every few years there's a story like that.
Yeah, so even with all their bailouts they've gotten over the last couple of years, they're still bleeding out dollars. Turkey did the blunder, and I'm half Turkish. My dad's from Turkey, so it pains me to see the, idiocy going on there. But, the central bank and Erdogan refused to, recently they did. They had the central bank hike like 2 bips, but too little too late at this point. They've already bled through all their reserves. So you have all these countries, emerging markets with a ton of dollar debt that need dollars to service these debts. I mean, they could go bust, but I guess we'll see how that happens. But as long as U.S. dollar exports are slowing, there's not as much dollars trickling into the world because that's how we export dollars, either that and through debt. So with these rapid deficits, the idea of the inflation. Before we go to that topic. So this chart I have up.
Yeah,
like
the dollar.
We're just talking about on the dollar. Yeah, there's actually been the most shorts on the dollar, like speculative shorts, since 2017. So if the dollar keeps getting higher here, this could be a painful squeeze, and buybacks could send the dollar even higher. And I think I think it all comes down to stimulus, because the Fed can print as much as it wants, but if there's no money velocity, or if it's not getting into people's hands, they're just pushing rope. And I think we've learned this from Japan. We've learned this time and time again. And I see a lot of analysts talk about inflation, but there's 3 types of inflation. I really want to stress this. And I think if you or your subscribers really like reading, there's a great book about this that goes all the way back to 980. And it goes over like the big waves of inflation, like that last 100 to 150 years, and then like 75 years of deflation. It's called The Great Wave by the famous historian David Hackett Fisher. And it's a phenomenal book.
Yeah,
it's The Great Wave, Price Revolution, and Rhythm of History.
Okay.
Yeah, it's a phenomenal book. And basically, it shows that throughout history, there's been 4 to 5, we're in the 5th one right now, major price revolutions where prices start rising slowly. And before I get to that, so there's the 3 types of inflation. You have demand pull, which is if the population doubles overnight, and there's a fixed amount of goods, prices start rising because of the extra demand. Historically, after there was periods of no war, so there would be like, there weren't like the, wars going on in the medieval times, that men weren't dying as fast and they were having children younger with women. So there was more mouths to feed. So during peace times, it would just lead to a demand pull inflation. Not a lot, but like usually prices would rise on average 1 to 2% a year. Then you have supply side inflation, which is called cost push. That's like we see with oil. If the price of oil collapses 50%, the gasoline price goes down, probably not 50%, but it drops. So it reflects the actual commodity. So like in the 70s, we had the oil embargo that sent oil through the roof. An oil supply shock didn't help, obviously, from the deep breaking of the dollar, and it really kicked inflation up. And then you have the big one, monetary inflation. And that's throughout history. They finally learned around like the 1800s that, so back in the day when prices were rising, the medieval leaders said, hey, let's just melt silver down from swords, add it into the, if prices are rising, let's just give them more money. That just amplified the problem though. So they finally realized that in the third price revolution that, hey, printing money or adding money doesn't really help. So the reason
didn't the Romans do that?
Yes,
they went from, they would take a more valuable element out of their coins to eventually they became just kind of about a non-ferrous metal nothing.
Yeah, and actually that happened in London before. I just read another phenomenal book by Sam Levinson, Money for Nothing, about the South Sea bubble and how Isaac Newton pretty much like revolutionized their print, because London was on the silver standard while France and everyone else was on the gold standard in the late 1600s. But there were so many wars that they had to keep financing it. There was heavy outflows from London, and then they adopted like a credit-based monetary system. It was still backed by silver, but they wanted to use credit, and people started using the paper like demands coin slips. But the point was that there was a bad outflow of silver, and they were coin clipping, so they had to go take all the silver, pull it back in, and remint it, and make it a new value. And they said in the book like some coins were they were down like 70%. They were just like there was nothing left to them. So then but yeah, so those three types of inflation historically. So right now, I guess we'll just get to now that I see a lot of people we've been saying like hyperinflation the last 10 years. Personally, I believe inflation is a psychological thing, like hyperinflation, because it's when people realize the money's losing money, they start freaking out, and then it's like reflexive, and it becomes a self-fulfilling prophecy. While you're ditching money, prices go fire, and it cycles out of control. But let's just go to normal inflation. So like the book, yes, we do have inflation, and I believe we have inflation, and I hate the idea of it, obviously, because it's stealing from you and I. It's a hidden tax. Right. But it's over a very small amount. It's not like when you and me are going to the grocery store today, we're like, oh, wow, prices have doubled since last year. Some products might because of supply issues, demand, but generally prices don't triple. But you and I can look back and go, hey, 20 years ago, or we hear from like our grandparents, like, oh, 40 years ago, I was able to get, 50% more. So that's like that kind of inflation I was talking about from the early ages. It's like 1% to 2%. And historically, David Hackett Fisher in that book shows that over about 70 years, that's when people start noticing like it's more than marginal. Like, hey, wow, like my purchasing power has really declined. And then there would be like a grain shortage, like a farm was flooded back then, or a war broke out. And it would send prices skyrocketing, and it would lead to horrible like civil wars. The Edward II was overthrown in England over it. The Florence Empire collapsed over it. The Medici Bank went bankrupt. Like all these throughout history, all these problems happened. And then what happens? A plague, or from the war, people would die. Plague would wipe out 20 to 30% of people, especially because people were going broke and they were starving. Having the plague didn't help because there was grain shortages, so they weren't getting any nutrients. So then after all that, you would also have all this new marginal production coming online because people were like, hey, we need to get more farming. So they would clear new fields and they try to harvest more. But because of that, and then all that supply plus people dying from plagues, it would lead to a huge long period of deflation, which was like the golden years, where workers had like the actual increase in purchasing power, real rents went down, et cetera. So David Hackett Fisher ended up passing away, I believe, if I remember right. And he pretty much left off saying we're in that wave, and we're in the fifth wave right now, like since the 1900s. And with the central banks, we've seen the inflation. But today I see everyone talking about inflation, especially a lot of analysts. But when you look at the demand side isn't increasing. Especially China is the marginal growth engine. Their consumer spending is weak. They're just doing barely enough. Since 2016, they're stimulating just enough, not to save the rest of the world. Like if you remember the 2015 China devaluation, a massive stimulus they did, they like bailed out the world. Same with 2008. Well, they're not doing that anymore. They're doing just enough to like not crash themselves, but they're not bailing out the world. And actually their finance ministry said, I read on Bloomberg today, that they're going to start normalizing policy soon. So it kind of shows that they're stepping away from excessive stimulus because they're trying to prevent, they have a debt bubble and they realize it. So the jury's out if they're going to be one of the first countries that are able to get out of a massive debt bubble without it, you know, being heavily deflated, like Japanification.
Yeah.
I don't think they're going to have much luck with it.
Okay, so clarify something for Hackett's saying we're in the final wave, and to me, you know, wave 5. Okay, so a final wave has all kinds of implications of the ending of something and the beginning of something new. Talk us through this 5th wave, what's going to happen, and then what changes it.
So basically, yeah. So after World War II, a lot of people's lives were lost in World War II. So, and then you also the baby boomers. So you had a lot of demand pull inflation. And then in the 70s, like how Jim Rogers got famous betting on commodities, there was huge commodity shortages. So, but since then, so it led to higher inflation in the 70s and 80s. Thing was in the 80s, while Paul Volcker was tightening, the federal deficit was barely, I think it just hit $1 trillion at that point. So Ronald Reagan and, you know, Congress had a ton of room to run fiscal policy, which they did, and they ran easing. The dollar was strong because of the monetary tightening, but they were able to offset it with huge tax cuts, you know, the Reaganomics. Right now in today's economy, we already have record deficits. The Fed rates were already at 0 before this crisis came. I was reading this great report from the BIS showing that for over the last 100 years, for central banks to get any kind of marginal stimulus, they have to cut rates by 3%. So I think that's why the Fed was trying to get rates up to 3%. So the next recession we were in, they could have cut and try to get some kind of growth, but they weren't able to get it up. They barely got it to 2.5. So now they're at 0. They're probably going to try yield curve next. That's what Australia just started doing. You have all these countries, you know, Japan's same never-ending problem with them. It doesn't matter what they print. But with the other way we were showing was, but the baby boomers now, so you had a lot of mouths to feed. So you had this 1950s all the way to the 90s, 2008 really, of growth. You had, you know, inflation was going higher, not too high, but, you know, above the 2% they wanted. It was, you know, debt was growing, home prices increasing, pretty much asset prices were growing faster than the debt. Well, after 2008, that changed. And now it's been heavily deflationary. You have tons of commodities have come online on the idea, like you and I were talking about earlier, that China and India are going to be these huge consuming nations. You had like Australia, Canada rally, all, you know, oil, every commodity is like overproduced right now. And they're just most commodities. Then you have the demand side. And also you have on the supply side, you have technology, cutting prices faster. You have places like making their packages smaller, et cetera. So they're kind of able to offset costs. Then on the demand side, you have the baby boomers now retiring. That's taking demand out of the system. Not to mention they're going to start pulling their money out to live off their bonds and et cetera. So that hasn't really happened yet because people are trying to save. But, you know, that is a threat for the deflation. World demographics are on the deflationary trend. You're having more deaths than births. Even in China, they're having like a record 300 million workers leaving the workforce in the next like 3 years. It's like a huge amount. So you have on the demand side, more also with this pandemic, you know, how much trillion in GDP globally, not just the US. Like if you look at every country, it was like negative 20% annual GDP drops. So you had a huge chunk of demand loss compared to what the government stimulated. Even if they gave everyone $1,200, I mean, the losses were still greater than what they tried to supplement. So those are the two inflations. So my thing is this. You have 2 out of the 3, you have demand and supply, the only that are deflating. Then out of the third inflation, monetary, the Fed's been printing like crazy. So if you have the Fed printing, but 2 out of the 3 are deflating, you have a deflationary kind of pressure, overwhelming monetary. Now, the idea is and this next wave, right now it's deflationary except for the monetary, because also with debt is very deflationary. We have a ton of debt in the system. Now, if the Fed is telling fiscal, like they're going to Congress. I'm sure you've seen, they go there and they're like, you guys just get it together, agree,
Yeah.
do a damn stimulus. We got you. We're going to print the dollars, buy your bonds. Like, don't worry about it. Like, just do it. And now they can't agree. That's always what happens. Like, even back to the Rome days, you know, it just, you know, the both sides can't agree. Exactly.
Yeah.
So until they get some kind of stimulus going, which I don't know if it'll even be enough. I mean, we'll see. But until they can get something going that can actually tip one of the two, demand side or supply side, into the inflationary trend, I just don't see how you're going to have above trend inflation, which I personally like. But as like huge debtors and, you know, corporations, that's not good. And I think the longer this deflationary trend goes on, you're going to see bankruptcies increase. Like I just was reading this article I have, New York region sees 40% bankruptcy surge. You know, New York is obviously a staple of America, and the city is pretty much under chaos at the point. So I just don't know what's going to happen with the economy going forward. But I do think that there's going to be more deflation than inflation. And I think the euro's learning that the hard way right now. And with the Fed putting rates to zero, I'm sure you've noticed that bank stocks have completely collapsed because it crushes bank margins. So
Yeah.
I hope the US doesn't go to negative rates, because we've seen it doesn't work, and it's just going to kill our bank system.
Okay. How are you positioning yourself into this Hackett's fifth wave? Because you know, you brought up famine, and that created people bidding up everything and worried about their currency because of what they were paying for food and the implications of it. There are a lot of things happening in our grain belt that are threatening supply, and China coming in and buying beans. We have one of the smallest carryovers in beans that we've had in a long time. So another bad crop year could cause food inflation.
Yeah, you're absolutely right. And last year we saw that with meat prices. It was just one African swine flu tipped.
Right.
That was a big trade I did. I did on like a meat play in JBSA in Brazil. I'm still looking at that now for the next meat issue, but they're starting to rebuild their hog supplies. But that doesn't take away the threat, especially with African swine flu. The contamination of that disease is crazy, how fast it can spread. And if it even get a hint of it from one farm, they have to go slaughter all the pigs.
Isn't that what happened in China? I mean, like 75%.
Yeah,
they had to get rid of. Yeah.
They culled pretty much their entire pig population. It was terrifying. So yeah, you are right. Like, so after the 70s, when food prices went up, it brought on a ton of marginal production, because people, like, sugar prices went up like 1,000%.
Yeah,
and
I remember
so
40-cent sugar.
Yeah, so sugar, farmers were like, hey, I'm going to become a whatever sugar entrepreneur. They came on, they do have the capital cycle kick in, and they start trying to soak up the profits from the higher sugar price. But now all that extra supply builds up for years, and like we had big grain storages in the early 2000s, but now they're depleting. So that's why I've been reading like Jim Rogers, and he's saying he's getting bullish on commodities, mainly because, like you were saying, the storage of our commodities are depleting. They're in like a negative trend. So that could be something, obviously that could tip
on the
scales
horizon.
on the inflationary side. I mean, we saw what coronavirus did. Just from the demand pull inflation, we saw supermarket inflation increase. That's the only thing that's actually been on our CPI. Like, everything else has been going down. The only thing that's been going up was grocery stuff, just because of coronavirus. So I want people to understand that those three types of inflation all work against each other. They're in their own reflexive feedback loops, pushing against each other. And I think if we get one more, if the Fed is easing and the other two are deflating right now, it's marginally deflationary. But if just a big oil glut happens, oil like embargo, or any kind of main commodity like food, especially, shortage happens, or a couple crop failures, or pig or meat, like I just saw in the US they were culling a lot of pigs too that weren't being eaten, just wasting it. So one thing like that could tip
milk, pig, people, the farmers were crying because they kind of have an attachment to them. What about when you talk about China and Hackett's fifth wave? What about war with China?
So yeah, war, generally, so the unrest from the money issues usually lead to war, and it's always been kind of like, I'm sure you know the Keynesian things, like, hey, if we knock things down, we can rebuild. War has always been a way to like kind of cull the population, while at the same time it produces a lot of demand. And I don't mean that as, who knows if our leaders actually do that on purpose. I don't know, but just looking at it from a perspective, usually in times of like Great Depressions and famines and unrest, it leads to upheavals. Usually it's another group overthrows, there's like a civil war, and it overthrows the leading group. Like the Spanish Empire ended up collapsing from Napoleon in the early 1800s. He ended up ruining the Spanish Empire. And if you see what happened there, that was the French Revolution literally led to Napoleon, which led to the 7 coalitions. So
you are really so well versed, well read, Adam. I could talk to you for hours. And,
I love reading.
Really. So I'm gonna check out Hackett's book, and what a great chart on the dollar. And we have to wrap it here. So what's the best way for people to follow your, you're a student of history, and is your website the best place to go, or Twitter?
Yeah, Twitter at Radical Adam. And if I'm
you're
on
not
my
that
site,
radical, you're just a thinker.
Yeah, I just it was from my favorite anime,
all
Cowboy Bebop, the name Radical, so I just added it with my name. But I actually have a reading list on my website, free, that I have like a bunch of history books and everything that everyone's please check out. It's a lot of my favorite books. I'm going to update it soon for a lot of books I've added, but every book I read that I like, that I find is practical wisdom, definitely goes on there.
All right, Ed. Well, I tell you what, Adam, my trading warrior brother, we'll have you back. You're one of my regulars now, so
I appreciate it a lot, and thank you for having me. Sorry for the long-winded ramble.
No, it gave us lots of food for thought. In fact, so much I may have to eat a Tums or two to digest it all. All right, buddy. So everyone, check out Adem and his work, and if you're interested, he's a student of history, and you have to be aware of history, because things don't always repeat, but they usually at least rhyme. So that's going to be a wrap for today, Turnaround Tuesday, and I guess we'll see everyone tomorrow, hopefully. And don't just count your, your grain, your stockpile of anything, your portfolio, count your blessings. And you're welcome, Sam, Forex Gal, Brock, and thanks to Dem once more. And we'll see you all tomorrow.
Great. Thank you for having me.
All right. Thank you again, Adem.